Investment decisions or capital budgeting. What does it mean? So capital budgeting or investment decision is nothing but investing huge fund for any assets or new projects or new construction of any property or development of any assets, intangibles and all. Once you have invested, withdrawal of that fund will be always tough. So you have to be double cautious before you invest. Whether the investment will be worth or not, you have to understand. Otherwise, it's a great loss for the organization. So, investment of funds in long-term projects as well as asset. Especially this investment decision guides you whether that investment is worth, can we choose or not, will be guided here. Okay, long-term projects and assets. And because of this investment, benefits are expected over series of years, probably 5 years, 10 years. Constructing one building gives you a benefit of occupancy of the property for more than 30 or 20 years. Okay, for example, like setting up factories, installing a machine, creating additional capacity to manufacture, all these things are the nice examples for the capital budgeting. And one thing you have to be careful, after you decide to start investing in the capital asset, if you think that may not be viable and you want to come out of that, it's great loss. Withdrawal of the project causes a huge capital loss, and recovery of this will also be a problem for you. So you have to be double cautious before you invest. You have to think whether this investment really worth or not. Only then you can plan to invest here. That's why this particular chapter is so important. Even though if you go for borrowing the loan from the banker, the first question, why do you want to borrow? You say that I supposed to install a machine, or I want to start up a company with a factory. Immediately the next question, is it viable to invest? How much fund do you need to invest? Will you be able to repay the borrowings you have taken for the investments? Along with the interest and all, will the project will give sufficient cash flows? And all these questions may be addressed. Further, also the bankers expect some methods. So those methods also covered here. If you want to suggest to borrow the loan, a project report should be given to the banker to sanction the loan. That project report also contains these techniques. Now, we need to depend on capital appraisal techniques. We have some techniques. Before you invest, we have to question ourselves whether it's worth investing or not. So question it. Is it worth investing or not? Is answered based on these techniques. If these techniques are supporting that investment is really worth, then you invest or you stop investing. Okay, or you can stop investing. That's going to be studied here. We have been given almost 11 techniques here, but most probably you may be strong with around 5 or 6 methods. These 5 or 6 methods are most important for your exams. Anyhow, understand the variance also, and what will be the decision you can take based on these appraisal techniques. What could be the criteria to decide in case of mark? A scores 50 marks, B scores 60 marks. Naturally, who is better? A or B? B is better. A scored 50th rank, B scored 60th rank. Who is better then? So then the answer is totally different. A is better. So in case of rank, lower is better. In case of mark, higher will be the better. Same happens while calculating the results using the appraisal technique. Sometimes the value should be higher, sometimes the value should be lower. So based on that, you can decide whether this project is good or not. For example, if you are thinking about profitability, A gives 100 rupees profit, B gives 150 rupees profit, which is better. 150 naturally better, right? And suppose A says, I give you profit of rupees 100, and B says, I give profit of rupees 150. Naturally, you say B is better. Okay. But in detailed analysis shows that investment requirement for A being 1000, for B it is 2000 rupees. Now you think 100 rupees you are getting for 1000 rupees of investment, it means you are getting 10% return from A. In case of B, for 2000 you are getting 150, it means you are getting only 7.5%. Is that okay? In this case, A is better. Clear? So you have to be double cautious. it's not only about the higher number or sometimes lower number, it's collection of those things. The method you have chosen, based on that you can plan whether you have to choose based on the lower number or higher number or not, and all, right? So we have been given almost 11 methods here. I am going to guide all these 11 methods in detail one after one for the conceptual clarity. In the morning session, I offer you some other additional illustrations similar to the illustration what we are referring here for extra practice. Go sit and work additional problems along with me, so that will be master here. This particular chapter, of course, for the life requirement, most important before you go for investing. For the exam requirement, it carries around 10 to 15 marks. So if you are strong with this, you will be able to score decent 10 marks. If you cover around 4 or 5 chapters similar to this one, which gives you 10 marks each, for 4 or 5 chapters, you will be getting a base mark for passing. So of course, the exemption will also be possible for the rest of the topics. So one of the most important chapters to score the basic 10 marks here, right? Let's start with this chapter here now. Now, you have to understand the difference between net profit as well as cash flow. Always remember, the net profit is not equal to the cash flow. Is that okay? So, for example, in your P&L account, okay, your GP being 100 and your depreciation being 40 and other admin and selling and distribution expenses being 20, you get a net profit of rupees 40. Right. So your net profit being 40. If I ask you, what about the cash benefit or cash inflow? Right. Due to the depreciation, profit may go down, but cash will not go down, because it reduces the assets balance in your balance sheet. This admin in your balance sheet, from cash, you subtract the admin expenses. In case of depreciation, from the asset, fixed asset, you subtract the depreciation. So cash affects only due to the administration, not the depreciation. So if I ask you how much cash balance you have after this transaction, so 40, not only that, this extent money has not gone out, it is in your hand only, so you have to add the 40 also, you will get 80 rupees. Is that clear? So you have to understand the net profit is not equal to the cash flows. Now the question is, will the cash flow matter for me or net profit matters me? That's the question. Do I want to consider the net profit or cash flow? So most probably in financial management, we bother about the finance, cash, not the net profit. Net profit is probably by adding some extra non-cash expense income and subtracting some non-cash expenses and all, you can manipulate, but I want to know what is the cash I have in my pocket. So the cash flow means in capital budgeting to appraise whether the capital budgeting investment is worth or not. Okay, worth or not can be appraised using the cash flow only, not net profit. Most of the cases, all the methods, we have almost 11 methods I just communicated to you. Among the 11 methods, except one, most of the cases we will consider only the cash flows. Cash flows. For example, fourth one, accounting rate of return. In case of accounting rate of return, we will consider the profit base. Other than that, we will consider only the cash flows. So many methods we have. Among all the methods, accounting rate of return considers the net profit. For 100 rupees of my investment, how much profit I am getting? In other cases, for 100 rupees of investment, how much cash I am getting? That's a question. You understand? Cash or net profit. And net profit and cash are not the same. You ought to understand. Right. First point, I just explained to you about profit and cash flow. Here, profit. For the rest of the cases, it's a cash flow. Next case, the 100 rupees what you have in your pocket in 2025, similarly, you have 100 rupees in 2026. My question is the two value are same? Definitely not so. Whatever the 100 rupees you have in 2025, if you deposit in bank and sit ideally, that 200 rupees becomes 105 or 106 due to the interest component. Naturally, this 100 becomes 105. Clear? So you have to understand the 100 becomes 105 means the 105 of today is equal to, sorry, the 100 rupees of today is equal to 105 in the later period, not 100 rupees is equal to 100 rupees. This will be correct and this will not be correct. Clear? So the the money gets its value appreciated or depreciated based on the time also. If you consider what's the 100 rupees you have in future, the future value will be higher. Future values money is worth, if I consider for the today's value, it may be lesser. Okay. So how can you consider? You are investing today for rupees say 1000 and you are getting the money back by the end of say, first year or second year, like by around 500 rupees. Literally comparing, you invested 1000 rupees today, sometimes later you are getting 5000 rupees, you are getting 4000 rupees higher, so it's worth the project. Can we say so? Definitely not so. Because you invested today 1000 rupees, you are getting 5000 rupees tomorrow. I'm not sure which tomorrow is that. Is it 1 year later or 2 years later or 10 years later or 100 years later? I'm not sure. If it is 100 years later, today's worth, after subtracting the interest component for these 100 years, maybe around 4500 rupees, then it becomes only 500 rupees. You are getting only 500 rupees later. For that, you are investing 1000 rupees, it's not worth. 5000 rupees, what you get later is along with the interest. Remove the interest component. So, to get today's worth, you can compare these two, not these two. These two comparison is not acceptable. Clear? Clear? So, whatever the cash value you have, always cross verify whether these values belong to the same timeline, same time period. I am talking about 1st January 2026. The cash outflow, cash inflow should always be to the date of calculation, probably 1st of April 2026. Okay, if it is not so, you have to do some adjustments. Any cash later than 1st April 2026 to be brought to 1st April by removing that interest component, means automatically the value will be decreasing. If the value is today's worth, probably by 1st January 2025, you take it to the 1st April by adding 3 months interest. Such a way, you either add or subtract the interest to arrive the value of cash you have by the day of calculation. That is called adjusting the time value of money before we proceed. Adjustment of time value of money. So, these 4 methods where we never bother about time value of money, not time value of money not considered model. And these models are where we put importance for the time value of money also. 5, 6, 7 and all. And of course, we have the variance also. You be master with this one only. Payback period and net present value, profitability index, internal rate of return. These are the 4 predominant methods you expect in your examination. Sometimes, rarely you will expect accounting rate of return. Okay, these are the 5 methods. The rest of the methods, very, very rare. At least you need to know what are the methods and how can we use that technique for appraising the capital budget investment. Is that clear? Hope. So, I have covered 2 points. One is, can we consider the profit or cash flow? Most of the cases in our all the capital budgeting appraisal technique, we have to consider only the cash flow except accounting rate of return. Otherwise, it may be named as average rate of return. That's how you can name it. Accounting rate of return or average rate of return. Number 1. Second thing is time value of money is going to be considered. Today's 100 rupees is not equal to tomorrow's 100 rupees. Always these two are not matching. Tomorrow's 100 rupees will be less valuable than today's 100 rupees. Okay. So you have to always bring all the values equivalent to a timeline in which date I am going to calculate. So if I am going to calculate for 1st April 2026, you have to bring all the cash flows, either inflow or outflow, to that date, 1st April 2026 for the comparison. That is all about adjustment of time value of money for the cash. That adjustment of time value of money is most important for these 3 methods, 5, 6, 7. In these 3 cases, 4 cases, we don't bother about the time value of money. And of course, here we will consider the time value of money also. These are the additional models. You can have small knowledge about that, right? Now, some variants also we have. Okay, capital rationing problem and what are the types of problems you can expect. So, I have given around 6 different types of problems you can expect in your examination. And you have to understand the concept called capital rationing and all. Rather than naming all these terms here, let me start solve illustrations one after one. After completion of the entire chapter, you can get back to this one. You will be able to understand these are the methods we have studied, right? So one after one. So now, before we proceed with the illustrations, first thing that you have to understand is all about Time value of money considered model, not considered model. We will consider only the cash flows in most of the cases. Some cases only one case where we will be taking the net profit. Right? Clear? Now, techniques of capital budgeting. Techniques of capital budgeting. Clear? Now, cash outflow at 0th period. In subscript, it is 0, represents 0th period. Project A is 1 lakh and project B is 1.5 lakhs. We have two projects, project A and project B. Now, it's my duty to select between these two, which is the best one for my requirement. Project A requires 1 lakh rupees as cash outflow. Is that okay? What could be the cash inflows? What about the cash inflows? So we have two parts. Okay, this is the cash inflow for A and this is the cash flow inflow for B. Let me first focus on what? A. Then we'll proceed with B. Then we'll compare between these two, which is the better one. Okay, which is the better one. Now, what does it mean? You always have this picture in your mind, timeline. 0th period, period 1, period 2, up to 4 years, right? So, period 3 and period 4, right? Is it needed? No, definitely not required, but it's better to have the timeline also. At 0th period, 1 lakh rupees is the cash in outflow. So, you spend around 1 lakh rupees at 0th period. Because of that payment, you will be getting around 40,000 rupees year on year. So, first year you are getting 40, second year you are getting 40, third year you are getting 40, fourth year also you are getting 40. Is that clear? Almost 440,000 rupees, 1 lakh 60 you are getting, but you have invested only 1 lakh. In absolute sense, directly if you refer, for the 1 lakh rupees of cash outflow, you are getting 1 lakh 60. It means you will be getting around 60,000 rupees surplus without considering the time value of money. Okay, we have to consider the time value of money in most of the cases, right? Some methods where time value of money is least botheration. Okay, because I want to calculate easily. I don't want to go for the mathematical calculations and all. I want to calculate immediately whether it's worth investing or not. Of course, forget about the time value of money. You get 1 lakh invested and you get 1 lakh 60 sometimes later. Anyhow, decent. You get 60,000 rupees profit, happy. But in minute sense, if I could have invested in the bank, I may get interest, right? So that interest will be taken care here. Then time value of money comes here. Now, KO represents cost of overall capital. KO represents cost of overall capital. It is 10%. It means for this business owner, whenever he invests money here, he needs to borrow or he needs to divert the fund which gives some return. I have 1 lakh rupees that gives me 10% return. Okay, already I have 1 lakh rupees. From there, I'm getting 1 lakh rupees. If I want to start this business, I have to divert the money from there. Means 1 lakh rupees, what we already invested is withdrawn and invest here. It means I'm losing the 10% return there. Okay, that is called my cost. Sir, no sir, I don't have even single penny in my pocket. What can we do? We can go and borrow. If you borrow, you have to give 10% interest to the banker as interest. Anyhow, that 10 rupees is called your cost. So always remember, whatever the amount you invest here, that should give the return beyond that cost. Your cost is 10 rupees, then that business should give you more than 10 rupees, only then it's worth investing. That's very simple to understand. Clear? Now let's start. Calculate one after one. Number one, payback period. Number one, payback period. What is called payback period? Whatever the money you paid, you have to get it back. That's all. Paying it back. Very simple sense. So for that, the answer being number one, payback period. Payback period. In case of payback period, the cash inflow may be uniform or ununiform. For project A, future cash inflow being uniform. Uniformly, you are getting 40,000 rupees year after year. But when it comes comes for the B, you are getting ununiform. Okay, ununiform. Is that okay? In case of uniform, the calculation is very pretty simple. How can you calculate? Payback period is nothing but the amount you invested, you have to get it back. Within how many years you will be getting your money back? Come on. You invested 1 lakh rupees, very first year you will get 40. Second year you will get another 40, 40 plus 40, 80. Third year you are getting another 40, 1 lakh 20, which is beyond your requirement. So by the end of third year, you are getting more than what you have invested. Then at what point in time you are getting your money back? It may be anywhere between 2 to 3. 2 to 3. 2 years you get 80,000 rupees. Another shortage 20,000 rupees. For the entire third year you are getting 40, means for getting 20, half year will be need. So within 2.5 years I will be getting back. So how do I calculate? 40 in the very first year, another 40 in the second year. So cumulatively for the first year end, I get 40, second year end, I got 80. Third year end, I get another 40, means 120, but I don't want 120, I need to get only 100 rupees. It means second year I get 80 rupees, another 20 rupees is the shortage. So you have to add 2 years plus some more extra month to get my money back. For the third year, for the entire 12 months, 1 year, I'm getting 40, but I need to get only 20, half. Absolutely half of the year, maybe 0.5 years. So 1 year you are getting 40 rupees, but my requirement is only 20. How many years I have to wait for? Another half year. So I'm getting my money back by the end of 2.5 years. What about the time value of money, sir? Time value of money is not required to be considered here. Time value of money is not required to be considered. Clear? Now, in case of payback period, where the cash inflow being uniform, you can use this formula also. Cash outflow divided by cash inflow. This formula will be applicable only when the cash flows being even or equal. Clear? So the cash outflow in this case being 1 lakh rupees and the cash inflow being 40,000 rupees year after year. Now this 1 lakh is divided by 40,000 rupees, you will get 2.5 years. In 2.5 years, you will be getting the money back. In a normal layman's understanding, we discussed and found out that 2.5 years, but mathematically it's cash outflow by cash inflow, right? Okay. So we have completed the payback period. Payback period, we never bother about the time value of money. Okay. Now, next one is all about payback reciprocal model. What is called reciprocal? What is called reciprocal? Inverse. Inverse. Inverse is nothing but reciprocal. I give and you have to give me. You are giving me fees, I am giving you my knowledge. Give and take, reciprocal. Okay, I will give and you will give. Similarly, it's an inverse. What I get because of I am giving. What is the inverse of the 2.5? What's the inverse of the 2.5? That is called reciprocal. Inverse of 2.5. 1 divided by 2.5. 2.5 means 2.5 divided by 1. Inverse means 1 by 2.5. That's all. So second is all about payback reciprocal. Payback reciprocal. Clear? This is nothing but 1 by payback period. 1 divided by 2.5. You can represent that in percentage, 40%. What does it mean? For the investment you have made every year, you are getting 40% of your money. You have invested 1 lakh rupees, very first year you are getting 40,000 rupees. Sir, it is very simple, no sir. Don't you want to use the cash inflow by cash outflow formula, sir? No, not required, because this is being uniform, it's okay. But if it's not uniform, then there will be trouble. So you have to find out the payback period, and inverse of that will be the reciprocal model. Clear? Clear? Now, let's move on to the next one. Let's move on to the next one. Okay, payback profitability. Payback profitability is nothing but the amount you are getting beyond your investment in absolute term. How much you are getting? 1,60,000. How much you are investing? The difference between these two is your payback profitability. The main drawback of the payback period is we consider only the payback period. Whatever the cash I get beyond the payback period, we never bother. My intention is if I invest, how quickly I get my money back. That's what about the main motto of payback period. Okay, what about your intention? What about your intention to invest somewhere? You might have interacted with your parents, right? What about your intention for writing the exam? Huh? All India topper, state topper, district topper, just to pass, sir. That's my intention. The same happens here also. If you ask your parent, what about your intention to invest? Safely, I have to get my money back. Thereafter, how much I get, okay, that will not give a sense of high satisfaction. If I tell you, you invest today 1 lakh, you'll get 1 crore later. Will I get that 1 lakh first? Safe 1 lakh first. Thereafter, if there is a luck, you will get it. Okay, then happy. So you always be cautious to pass minimum. Thereafter, all in the topper, God's grace, I can enjoy that one also, right? The same happens. Similarly, whatever the amount you get beyond that is immaterial. We never bother in payback period method. But anyhow, I want to know that one also. Beyond that also, how much I'm getting. That's also one more intention. For that, this payback profitability method is used. Post payback period earnings. So here, third one, payback profitability. Payback profitability. Total cash inflow minus cash outflow. The total cash inflow, every year you're getting 40. So 40 every year means for 4 years you are getting 1,60,000, but cash outflow is 1 lakh. The difference between these two is 60 is your payback profitability. Beyond your payback period, still you have 60,000 rupees. In all the three cases, we have not referred time value of money. We have not referred time value of money. Is that clear? Now, let me explain here. Time value of money not considered model. One is all about payback period. As per this appraisal technique, shorter period is the better one. How quick I am getting my money back will be the most desirable plans to be chosen or projects to be chosen. Okay. And why do I want to choose CA rather than BCom? Because CA gives you more pride and prestige and money and all. But why do you want to still prefer to go for BCom rather than CA? The admission goes for CA, BCom only more rather than CA because payback period is lesser. In 3 years, you'll get your degree back in your hand. Okay, when it comes about CA, oh my God, I don't know. The destination is always question mark when the thing will be reachable, right? So that's the question. That's the question. Clear? Okay, shorter is the better. I want to safeguard my money invested BCom. I need the pride. Go for the CA also later. CA or CMA later on. Second one is payback reciprocal. Payback reciprocal is nothing but inverse of payback period. 2.5 years, okay. So in this illustration, we thought the amount what we have invested, we are getting it back in 2.5 years itself. So my next question is, out of my investment, how much I am getting every year? 40,000 rupees. 40% I am getting every year. So that's what about the payback reciprocal. As my intention is to get my investment back, that too short duration is most preferable choice for me. Okay, I want to know what extra amount I will get beyond that payback period. If I have that question also in my mind, then it will come under profitability, payback profitability. Payback profitability. These are the three cases you have to understand. Payback period, payback reciprocal, and payback profitability. Is that clear? Any doubts? Right. That 4, 5, 6, 7, all the four are based on the time value of money. Right. Before I go for this, let me summarize here. Okay. So we have two projects, project A as well as project B. Number one, payback period. A has 2.5 years. Second, payback reciprocal. Here 40%. Third one, payback profitability. Profitability 60,000. Three questions are addressed. I can calculate the same three for B also before I go for the time value of money based methods. Shall I move on to the next one? Come on, text me once it is over. Make it faster, make it faster. Online students, come on, text me so that I will move on to the next one. Keep interacting in text box. Now, let's see. Let me solve the same three appraisal technique for project B. When it's all about project B, the cash flows are not uniform, those are ununiform. In case of ununiform, let's try to solve one after one slowly. 4 years. The cash inflow I am getting in these 4 years for the project B, 60, first year, second year, 70, third year, 50, fourth year, 50. In which year I am getting my money back? First year 60, second year 70, almost 1,30,000. Third year 50, 1,80,000. In third year I am getting more than my investment. Second year less than my investment. So the payback period should be anywhere between second and third year. But I have to tell you exact year in which I am getting my money back. So for that we better use the cumulative cash inflow and then interpolation technique. Cumulative cash inflow. What does it mean? You have to find out that investment up to the second year end, like it's not second year's cash inflow, up to the second year's end, third year end, like that's called cumulative. Very first year end, I got cash up to 60. Second year end, I got 60 plus 70, 1,30,000. Up to second year end, I'm getting 1,30,000. And up to third year, I'm getting another 50 excess. So this is 1,80,000 up to fourth year. The last year, I get around 2,30,000 rupees. From this, it is very clear. Overall cash I get in this case is 2,30,000 rupees. As I already told you, interpolation technique. When I'm getting my money back here, my investment being 1,50,000, I'm getting that investment here exactly anywhere between second and third year. In this time, I'm getting 1,50,000. Am I right? From this, it is very clear. It is anywhere between second and third year. Then the main points that you have to understand here being second year, the next year's cash inflow, then the cash I need still by the end of second year to get my investment back, which is the difference between these two, which is 20,000 rupees. These are the three numbers are most important to find out the payback period here. Okay, second year I'm getting almost closer to the investment, but not to the extent of investment. Third year it's more than that. So definitely it's anywhere between second and third year. So automatically the lower number being 2 years. By the end of 2 years, how much money shortage I have? 20. The next year, how much I'm getting? 50. From this, it is very clear. In the third year, I'm getting 50, but I need only 20. Means 20 by 50 percentage of period is enough to get my money back. 20 by 50. So 1 year, out of that 20 by 50, roughly 0.4 years. 0.4 years. That's how you can get lower year plus the amount required by the end of this year 20, the amount I'm getting in the next year, which is 50 in the denominator. Now the ultimate value being 2 years, 20 by 40, 50 is nothing but 0.4, so 2.4 years. In 2.4 years, I am getting my money back. Clear? I am getting my money back. Clear? Next is all about what? You can represent that in terms of month also and days also. How? 2.4 years. This is 2 years. This is 0.4 year, or convert that into month. 0.4 year, 1 year has 12 months. If I multiply 12 with the 0.4, then you will be getting 4.8 month. 4.8 months. Still you want to get full number. Okay, you can say this way, either 2.4 years or 2 years, 4.8 months. Or you can further move on to this by this way, 4 months. And what about the 0.8 months? 0.8 months. 1 month carries 30 days. So that 0.8 month can be converted into days. 0.8 into 30, 24 days. So you can write this way, 2 years, 4 months, 24 days, or simply 2.4 years, or 2 years, 4.8 months. Now, anyway you can represent, no problem here. Anyway you can represent, there will not be any problem here. Clear? Clear? Now let's go for the payback reciprocal. Payback reciprocal is nothing but 1 divided by payback period. 1, the payback period being 2.4. Come on, represent that in percentage. 1 divided by 2.4 into 100. 21 point? Okay, 41.67 percentage. And when it is all about payback profitability, the amount you get beyond the my investment being 150, overall cash inflow from this project being 230. This is nothing but total cash inflow. This is what about the investment you have made at the 0th period for this project. That additional amount you are getting here is called payback profitability. Payback profitability. 80,000 being the payback profitability. Now, I'll write it down here. 2.4 reciprocal 41.67, payback profitability 80,000. Decision criteria. Decision criteria. In case of payback period, shorter is the best one. Okay. Then you have to choose B. In case of payback reciprocal, higher will be the better one. Then you have to choose B. In case of payback profitability, again, post payback period return should also be higher. So B is chosen. Is that clear? In all the three appraisal technique, we recommend B is the better one. So you have to go for B only. Clear? Hope now you'll be able to understand these three models: payback period, payback reciprocal, and payback profitability and all. Clear? For the even cash flow, for uneven cash flow, I just explained. In case of even, you can use the formula like cash outflow divided by cash inflow every year. But in case of uneven, you have to use only the cumulative cash inflow and find out the exact period in which we are getting. From the cumulative cash inflow, you have to mark when we are getting. So lower and higher number you have to identify. Okay, clear? Yes, make a note of it. Now, let's deal with net present value. Net present value. Okay. What is called net? What is called net profit? Income minus expenses is the net profit. Whenever we use the term net, it represents income minus expenses. What about? So what about the growth rate? Receipt means whatever the incoming minus outgoing will be the growth rate. Growth rate of the population. Birth minus death will be the growth rate. So whenever we say it's a net, it's always a net of the expenses. 1 lakh, 1 lakh 60, then automatically the difference between these two, 60,000 is called your net gain, net profit, net profit. You have invested 1 lakh, but you are getting 160. 60,000 is the net profit, otherwise profitability. Profitability, is that clear? But what about the present value? Don't say in absolute sense. 160 and this is 1 lakh. 60 is your surplus. But there is an interest component. There is an interest component. You have to remove that interest component, no? Isn't it? As already told you, 0, 1, 2, 3, 4. You have invested 100 rupees today, but you are getting 40 every year end up to 4 years. But this 40 is not equal to this 100. 1 year's end, 40 rupees is not equal to the 40 at the time of 0. If you have 100 rupees in your hand today, by the end of first year, as per your cost, 10 rupees you have to pay, it becomes 110. Am I right? This is 0th period value. This is first year value. And for the second year, what happens? Further 110 rupees, 10% interest will be addable. Interest for the second year. For this 10%, 11 rupees will be addable. So 121. This is what about the second year's value. For the third year, again you will be adding interest for the third year on this 121 at the rate of 10%. It is 12.1. This becomes 133.1. Am I right? For the fourth year, again this 133 rupees available in the bank will fetch me interest at the rate of 10% and this at the rate of 10% and this being 13.31. So this become 146.41. Is that okay? From this, it is very clear the 100 rupees what you have at 0th period will become 110 by the end of first year. Or the 100 rupees what you have here will be equivalent to 121 by the end of second year. Or the 100 rupees what you have today will be equal to 133.1 by the end of third year. The 100 rupees what you have today will be equivalent to 146.41 by the end of fourth year. It means all these values are same. All these values are same. Is that clear? Clear? 100 becomes 110. 110 becomes 121. 121 becomes 133.1. 133.1 becomes 146.41 along with your rate of interest at the rate of 10%. So tomorrow's 110 is equal to 100 rupees. Now year 1, 2, 3, 4. I will now calculate for project B. I am going to calculate for project B. Okay, project A itself. I can start with the project A. How much I am getting? Cash inflow. Cash inflow. I am getting 40,000 rupees every year end. First year end, second year end, third year end, fourth year end. You are sure that 110 by the end of first year is equal to the 100 at the 0th period. Right? 0, 1. If you have 100 here, it becomes 110. Isn't it? You have 40,000 rupees by the end of first year as cash inflow. 100 becomes 110. Otherwise, 110 is equal to 40,000 rupees means what about today's value? You can do the cross multiplication. It means 100 by 110. 100 by 110. Okay. So 10,000 into 100 divided by 110. What is the value? 36,363 point something. So I can round up to 364. This is called discounted cash inflow. What does it mean? At the 0th period, if you have 36,364 rupees in your hand, you could deposit in the bank. By the first year end, this deposit will give me interest at the rate of 10%. 10% on this is equivalent to 3,636. Ultimately, it becomes 40. Now you'll be able to understand. So this is just a reverse calculation. If you have 40, it becomes 44 by the end of first year. If I have 44 by the end of first year, what could be the today's value? You just do the reverse calculation. Clear? This is the logic. This is the logic. So similarly, 100 is equal to 110, 21. Then here it should be 100 by 121. And here 100 divided by 133.1. Here 100 divided by 146.41. Clear? Now remember, how do I calculate this value? Usually in your exams, this value may be given, named as PV factor, present value factor. At this rate, 10% rate, present value factor. The factor number may be given in your examination. No need to panic. How to calculate this PV factor, sir? So very simple. This is concept. This is concept. But for the examination purpose, apply simply the logics, the calculation steps. That's enough. How do I get the PV factor? Very simple. 1 divided by 1 plus I. 1 divided by 1 plus I. Here, this 10% may be the interest rate, otherwise 0.1. So here you see 1 divided by 1 plus I means 1.1. Is that clear? If it is 20%, how will you get this? 1 divided by 1.2. If it is 30%, how will you get? 1 divided by 1.3. If it is 8%, how will you get? 1 divided by 1.08. 8% is nothing but 0.08. So 1 plus 0.08, 1.08. That's how you get the answer. Is that clear? Clear? Now come on. Tell me. In your non-scientific calculator, okay, in your non-scientific calculator, you divide this by 1.1 in your non-scientific calculator. So if you calculate this way, what is the value you are getting? 0.909. Now, just press again equal in your non-scientific calculator. How can we calculate the PV factor? Okay, see here. One divided by 1.1. Okay. In your non-scientific calculator, if you have, just press equal, you will get the next number. 0.826. 0.826. Again, you just press equal. You will get the third value, 0.751. Again, just press equal. You will get 0.683. 0.683. Clear? Now, 100 divided by 110, you will get this value. 100 divided by 121, you will get this value. 100 divided by 133.1, you will get this value. 100 divided by 146.41, you will get this value. Isn't it? Cross verify? Of course, not required. But this one I have given to understand what is the process going on. Usually, for the calculation of discounted cash inflow is multiplied with the applicable PV factor. Applicable PV factor. You understand the logic? This is not required. This is not required. If you are clear with this, text me so that I will finish up this illustration comfortably then. Okay, come on, make it faster. So just to explain about the present value factors logic, why do I want to use this formula and all? But normally what you can do is very simple. Cost of overall capital 10%. Cash inflow for the 4 period is this one, cash outflow is this one. Year 1, 2, 3, 4. Cash inflow being 40, 40, 40 and 40. 10% PV factor will be applied here. Usually it is given in your examination. Yes, you can apply this formula 1 divided by 1 plus I. That way you can get it. Then here the value being 0.909, 0.826, 0.751, 0.683. Simply if you multiply these two, you will get discounted cash inflow. The discounted cash inflow in this case being, come on, tell me, 36,360. Here 33,040. Here 30,040. Here 27,320. Then overall total in this case being 1,26,000. 1,26,760. This is called summation of discounted cash inflow. Summation of discounted cash inflow. This is discounted cash inflow where all the 4 years values added. That is called summation of discounted cash inflow. From there we can subtract the cash outflow. The overall investment we have made in this case being 1 lakh can be subtracted from here, and balance being 26,760 is the NPV. This is the NPV. Is that clear? Now, in this case, the main point to be noted here is all about cash inflow seems to be uniform, and only this one is different. It means the uniform cash inflow can be taken straight away, and summation of this one can be taken here. The summation of all the 4 value usually named as annuity factor. Come on, get me the summation of these 4 numbers. 3.169. If you multiply these two, you'll get this one. This model cannot be used for the B, project B, because the cash inflow is uneven. If the cash flow being even, you can calculate independently or collectively. Independently, 40 into PE factor and group it. Collectively means you can take the one cash inflow, even cash flow 1, multiplied with the summation of the PE factor and anti factor, you will get the same answer. In your non-scientific calculator, how do I get this one? Very simple. So you do this way, 1 divided by 1 plus I. It means 1 divided by 1.1. Okay. So do this way, 1 divided by 1.1. Okay. Second time, see, I have the memory plus button here. You no need to use that one. So I press this, equal second year, third year, fourth year, 4 years over. The summation of all these things, I just put this button pressed. This is called memory receipt, which is 3.169. We got directly. In your non-scientific calculator also, 1 divided by 1 plus I equal, you'll get all the 4 values. You have GT button, grand total button. If you press the grand total button, you'll get the total directly. If you don't have the grand total button, you have to depend on the memory plus. How many of you have the GT button in your calculator? You have. Are you able to get that by pressing the GT? So you can use this. So how can do? 1 divided by 1 plus I equal 4 times equal, and then press GT button. By pressing the GT button, you will get the answer, right? So if the question doesn't contain the P factor and anti factor, don't panic. You can use your own existing logic to solve this illustration. Is that clear? Hope now you'll be able to understand the basic logics of this capital budgeting. I'll continue the rest in the